A credit card is a simple tool. It is a piece of plastic. It lets you buy things now and pay for them later. Think of it like a loan. A bank gives you a spending limit. You can use that money for purchases you promise to pay the bank back. This seems very convenient. The convenience is wonderful, but it comes with a catch. The banks are in business to make a profit, and that profit often comes from you, the cardholder. Now, let's pull back the curtain on the single most significant, and often most misunderstood, cost associated with using a credit card: interest. While we've touched on the mechanics of a statement cycle and grace period, the real financial impact begins the moment you carry a balance past your due date. This is where the convenience of credit can quickly turn into a costly burden, and it's the primary way credit card companies generate their profits. It's a cost that works silently in the background, often unnoticed until it has grown into a substantial amount. Understanding how it works is the most critical skill for any credit card user. The key to understanding interest lies in a three-letter acronym you'll see everywhere: APR, which stands for annual percentage rate. As the name suggests, this is the price you pay for borrowing money over the course of an entire year. For example, an APR of 20% means that if you were to borrow $1,000 for a full year without paying it back, it would cost you $200 in interest. However, this annual rate isn't how the bank actually calculates your charges. The APR is more like a headline number. The real work happens on a much smaller, more frequent scale. To figure out your daily cost, the bank divides the APR by the number of days in the year, which is typically 365. This gives them what's called the daily periodic rate, or DPR. So, if your card has a 21% APR, your daily rate would be 21 divided by 365, which comes out to approximately 0.0575%. This number looks incredibly small, almost insignificant, and that's precisely why interest can be so deceptive. It doesn't feel like much on any single day, but it's applied relentlessly, day after day. This tiny percentage is the engine of the interest machine, working quietly and consistently against your balance. Credit card companies use this daily rate to calculate interest based on your average daily balance. This means they are tracking your balance every single day of the billing cycle. If you make a purchase, your balance goes up. If you make a payment, it goes down. At the end of each day, they apply that tiny daily periodic rate to your balance. But here's the crucial part: the interest charged today is added to your balance tomorrow. This is called compounding. Compounding means you aren't just paying interest on the money you originally spent, you are paying interest on the interest that is already accumulated. It's a snowball effect. A tiny flake of snow at the top of a hill can become a massive, unstoppable boulder by the time it reaches the bottom. That's what daily compounding does to your debt. It creates a powerful cycle where the debt grows on its own, making it harder and harder to pay off with each passing day. To see this in action, let's use a concrete example. Imagine you have a $2,000 balance on your card from a large purchase, like a new laptop and some accessories. Your card has a 20% APR. Now, let's say you can't pay the full $2,000 when the bill arrives. Instead, you decide to pay only the minimum amount due each month. A typical minimum payment is calculated as 1% of the balance plus any interest and fees, or a flat amount like $25, whichever is greater. This is the smallest amount the lender will accept to keep your account in good standing. For your first payment, the minimum would be around $53. It seems manageable, but of that $53, about $33 is just to cover the first month's interest. Only $20 actually goes toward reducing your $2,000 debt. The next month, you're charged interest on the new, slightly lower balance. If you continue this pattern, paying only the minimum each month, you would be trapped in debt for over 11 years. And by the time you finally paid it off, you would have paid an extra $1,630 in interest alone. That's on top of the original $2,000 you spent. Your $2,000 laptop effectively cost you over $3,600. That extra money is purely the cost of borrowing. It's money you didn't spend on any goods or services, it's the price of time. Think about the opportunity cost of that $1,600. That money could have gone toward a down payment on a car, a fantastic vacation, a significant boost to your retirement savings, or paying off other, higher priority debts. Instead, it went directly to the credit card company's bottom line, all because the balance was carried from one month to the next. This is the hidden tax on convenience that millions of people pay without realizing the true long-term expense. So, what is the single most effective strategy to defeat this sneaky cost? It's simple in principle, though it requires discipline in practice. pay your statement balance in full every single month without exception. Make this your non-negotiable rule for using credit cards. Treat your credit card like a debit card. If the money isn't in your bank account to cover the purchase, don't make it. When you pay your entire statement balance by the due date, the interest calculation never even begins. The bank legally cannot charge you a single penny of interest on your purchases. The daily compounding, the periodic rates, the average daily balance, none of it applies to you. You effectively sidestep the entire interest-generating system. By doing this, you transform the credit card from a potential debt trap into a powerful financial tool. You get to use the bank's money for free for a short period, that valuable grace period we discussed, which can be anywhere from 21 to 55 days. You get all the benefits, the convenience, the security, the rewards points, without any of the cost. This is how you win the credit card game. Every month when your credit card statement arrives, your eyes are likely drawn to a few key numbers: the total balance, the due date, and one particularly tempting figure, the minimum payment due. It's presented as a simple, easy option. On the surface, it seems like a helpful feature. Paying a small, manageable amount, like $25 or $50, can feel like a lifeline, especially during a tight month. It provides a sense of control, a way to meet your obligation without straining your budget. And technically, it does accomplish one important thing. It prevents you from being hit with a late fee and keeps your account in good standing for that month. It's the bare minimum required to avoid immediate penalties and a negative mark on your credit report for a late payment. However, this is precisely where the danger lies. Relying on the minimum payment is one of the most common and costly financial traps you can fall into. It's a strategy designed not for your benefit, but for the credit card issuers. It keeps you in debt longer, maximizing the amount of interest they can collect from you over time. To understand why, you need to look at what that minimum payment is actually paying for. The minimum is often calculated as a small percentage of your total balance, plus any accrued interest and fees from that month. This means the vast majority of your small payment is immediately consumed by interest charges. Only a tiny fraction, sometimes just a few dollars, goes toward reducing the actual principal, the money you originally borrowed. Let's break this down with a realistic scenario. Imagine you have a credit card balance of $3,000. Your card has a fairly standard annual percentage rate, or APR, of 18%. Based on the issuer's formula, your minimum payment might be calculated as 2% of the balance, which comes out to $60. Now, let's follow the money. In the first month, the interest charge on your $3,000 balance is $45. When you make your $60 minimum payment, 45 of those dollars go straight to the bank to cover the interest. That leaves only $15 to chip away at your actual debt. Your new balance is now $2,985. You've paid $60, but your debt has only shrunk by $15. If you continue this pattern, paying only that $60 minimum each month, you are embarking on a very long and expensive journey. It will take you over 10 years to finally pay off that initial $3,000 debt, and the total cost is staggering. Over that decade, you will have paid more than $2,500 in interest alone. That's extra money you've handed over to the credit card company, almost as much as the original amount you borrowed. You effectively paid for your purchases almost twice over. This is the minimum payment trap in action. Now let's see what happens when you decide to break free from this trap. The solution is simple. Always pay more than the minimum, even if it's just a little extra. Let's revisit our $3,000 debt at 18% APR. Instead of the $60 minimum, what if you committed to paying a fixed amount of $100 every month? That extra $40 a month makes a monumental difference. In the first month, your $45 interest charge is still covered, but now $55 goes toward the principal instead of just $15. Your debt is being paid down almost 4 times faster. By paying $100 a month, you would clear your entire $3,000 balance in just under 4 years, not over 10. And the total interest you'd pay would be about $1,100. By adding just $40 to your monthly payment, you save yourself more than 6 years of debt and over $1,400 in interest charges. That's a huge return on a relatively small change in your payment habits. The power of this small change cannot be overstated. Even an extra $20 or $50 a month dramatically accelerates your debt repayment. It shifts the dynamic in your favor. Every extra dollar you pay above the interest charge goes directly to reducing your principal. As your principal shrinks, the next month's interest calculation is based on a smaller number, meaning less of your payment is eaten by interest, and more goes to principal. This creates a positive snowball effect. You cut the total interest you'll ever pay and significantly shorten the payoff time. Think of it as buying back your future financial freedom, one extra payment at a time. The minimum payment is a safety net to avoid a penalty, not a recommended payment plan. Your goal should always be to pay your statement balance in full each month. But if you can't, the absolute best thing you can do for your financial health is to pay as much as you possibly can, and always, always more than the minimum. When you use a credit card, you're operating on a timeline defined by your card issuer, and they are exceptionally strict about their deadlines. Understanding this timeline is the first step to avoiding unnecessary costs. Every month, your billing cycle ends on a statement closing date. This is when the issuer totals up all your charges for that period. A few weeks later, you have your payment due date. This is the final day you can pay your bill without incurring a penalty. The time between these two dates is known as the grace period, and it's a crucial window to pay in full and avoid any interest charges. If your payment isn't received and processed by the issuer by this due date, you're considered late. It doesn't matter if you initiated the payment on the due date. What counts is when the funds are officially in their hands. With electronic payments, this can be nearly instant, but it can also take 1 to 3 business days to process. So planning ahead is vital. If your payment arrives even 1 day after the deadline, you will almost certainly be charged a late fee. There's very little wiggle room here. The systems are automated to apply these charges immediately. Now, you might think these fees are arbitrary, but they are regulated. The Credit Card Act of 2009 put rules in place to curb excessive penalties. However, regulated doesn't mean small. For a first-time late payment, a card issuer can charge you up to $30. If you're late again within the next 6 billing cycles, that fee can jump to $41, or even higher if the issuer adjusts for inflation as the law permits. These fees are significant and can quickly add up, eroding any rewards you might have earned. One of the most surprising aspects for many cardholders is that the size of the late fee has no connection to the size of your balance. It doesn't matter if you owe $50 or $5,000, the penalty for being late is the same fixed amount. Forgetting to pay a tiny remaining balance can result in a fee that is almost as large as the debt itself. This is why vigilance is key, regardless of how much you've spent in a given month, but the financial sting of a late fee is only the beginning. The more severe consequence comes if your payment is more than 30 days overdue. At that point, your credit card issuer has the right to report your delinquency to the 3 major credit bureaus: Experian, Equifax, and TransUnion. This single late payment notation can stay on your credit report for up to 7 years. Payment history is the single most important factor in calculating your credit score, accounting for about 35% of it. A 30-day delinquency can cause a significant drop, potentially lowering a good score by as much as 60 to 110 points. This can make it harder and more expensive to get loans, mortgages, or even other credit cards in the future. So, how do you prevent this cascade of negative consequences? The best way to avoid late fees is to be meticulously organized. Don't rely on memory alone. Use the tools at your disposal. Set reminders on your phone or digital calendar a few days before your due date. This gives you a buffer to ensure you make the payment on time, accounting for any potential processing delays. Many credit card apps will also allow you to set up custom push notifications or email alerts to remind you when your statement is ready and when your payment is approaching. Better yet, for a truly hands-off approach, set up automatic payments. This is the most reliable way to ensure you are never late. You typically have 3 choices. You can auto-pay the minimum amount due, the full statement balance, or a fixed amount of your choosing. A great strategy is to set up auto-pay for at least the minimum payment. This acts as a safety net, guaranteeing you'll never be marked as late and protecting your credit score. However, it's crucial to bust a common myth. Paying the minimum does not stop interest. Interest will immediately begin to accrue on your remaining balance. You can then manually pay the rest of your balance before the due date to avoid those interest charges. This hybrid approach gives you both protection and control. Now, let's talk about another costly pitfall, the returned payment. This happens when you make a payment, but the transaction fails because you don't have enough money in the bank account you're paying from. This is often called a bounced payment or an NSF for non-sufficient funds. Just like with a late fee, your credit card company will charge you a penalty. This returned payment fee is often the same amount as a late fee, up to $30 for the first instance, and up to $41 for subsequent ones. The situation gets worse from there. a returned payment often triggers a painful double hit. Not only will your credit card issuer charge you a fee, but your own bank will likely charge you a non-sufficient funds fee as well for failing to cover the transaction. These bank fees can be $35 or more. Suddenly, one failed payment has cost you over $75 in penalties from two different institutions. Furthermore, the original payment is now void, which means your credit card bill is still unpaid. If this happens after the due date, you could then be charged a late fee on top of everything else, creating a truly expensive mistake. The solution here is simple but requires diligence. Always confirm your checking account balance before you schedule a payment. Make it a habit. Before you hit that submit payment button, take 5 seconds to switch to your banking app and verify that the funds are available. If you use AutoPay, be strategic about the date it's scheduled. Align your automatic credit card payment to fall a day or two after your regular payday. This simple timing trick ensures your account has been replenished and can comfortably cover the withdrawal, protecting you from the costly chain reaction of a returned payment. A cash advance is when you use your credit card to get cash from an ATM or a bank. It seems convenient, but it's one of the most expensive transactions. You pay a fee, there's no grace period, and the APR is higher. Withdraw $200, pay 5%, $10, and now owe $210. Interest starts immediately, often at 25% or more. Build a small emergency fund instead of using cash advances. Use your debit card to withdraw your own money. Far cheaper. Treat the cash advance feature as if it doesn't exist. Many cards charge foreign transaction fees, typically around 3%. Spend $1,000, pay an extra $30. Get a card with no foreign transaction fees before you travel. Some credit cards come with an annual fee, a yearly charge just to have the card. Fees can range from $25 to $700 or more. Banks justify fees with rewards and perks. Perks can include lounges, baggage, and special insurance. With a $95 fee and 2% back, you must spend $4,750 to break even. Spend more to come out ahead, spend less, and you lose. If you aren't a big spender, choose a no-fee card. Not getting value? Ask to waive the fee or downgrade with a product change to keep your credit line and account age. A penalty APR is a very high rate imposed if you violate terms. The most common trigger is a late payment, especially more than 60 days late. Rates can soar to 29.99% or more, turning manageable debt into a nightmare. Miss 2 payments and your interest could roughly double overnight. $62 a month becomes about $125 a month. Avoid penalty APRs by paying on time, even the minimum. Struggling? Call now. Ask about hardship programs and temporary rate reductions. Balance transfers can help, but they come with a fee, typically 3 to 5%. On $5,000, that's $150 to $250 added up front. Calculate to ensure the savings exceed the fee. Overlimit fees exist only if you opt in. Don't. A declined purchase beats paying a fee. Some merchants add a 1 to 4% surcharge for cards. Decide if convenience or rewards are worth the extra cost. Say no to overpriced add-on services you don't need. You can monitor your credit for free elsewhere. Decline dynamic currency conversion and pay in local currency. Your card network's exchange rate is almost always better. Credit cards are incredibly useful. They provide convenience and security. They help build your credit history, but hidden costs can turn them into expensive debt. To summarize, here is your 5-step plan. First, always pay your bill in full. If you can't, pay over the minimum. Second, set up automatic payments or reminders to avoid late fees and penalty APRs. Third, never use cash advances unless it's a last resort. Fourth, do the math on annual fees. Fifth, read the fine print, decline add-ons, and pay in local currency abroad. Follow these rules to enjoy the benefits without the costly traps.